How to make $1,000 a week in gold. Why exactly $1,000 per week? The amount of $1,000 per week is equivalent to about $4,000 per month. And to provide this level of profit, you need either a fairly large amount of investment, if you use moderate strategies, or active trading, speculation, with high leverage. But this is risky. It is very important to realize that the results are influenced by deposit size, i.e., how much money do you have at your disposal. The chosen strategy, long-term investment or short-term speculation. The level of volatility in the market. How much do gold prices move in a day, week? Method A, speculative or short-term trading. What is the essence of this approach? You need to catch short-term fluctuations in the price of gold, intraday or swing trading for a few days. For example, you can work with 1. CFDs, contracts for difference, available from many brokers. 2. Gold futures, traded on COMEX and other exchanges. 3. Options, for more advanced traders, where you can also profit from price movements. In each case, margin trading or leverage is used. If you, for example, have a deposit of $10,000, $20,000 and use leverage of 1.5 or 1.10, you can get a tangible income from a relatively small movement in the price of gold. Here is an example of potential earnings. Let's say you are trading gold futures. One standard COMEX contract equals 100 troy ounces. At a gold price of about $1,900 per ounce, the total face value of one contract is $190,000. You pay a margin which can range from 5 to 10% of the face value, between £9,500 and $19,000. If the price of gold has risen from $1,900 to $1,910 per ounce during the day, increase of $10 per ounce, then on a contract of 100 ounces you will earn $10. 100 pounds equals $1,000. With a successful series of trades, which is 2 to 3 trades per week, and provided that you do not hit losses, $1,000 per week can be quite achievable. However, if the market moves against you by the same $10, you will lose $1,000. Therefore, you should strictly observe risk management and use stop losses. Do not get into too big shoulders. What are the key success factors? 1. A well-positioned trading system. You know exactly when to enter the deal, where to place stop loss and take profit. 2. Sufficient capital to withstand drawdowns and not to get under the forced liquidation of the position. 3. Ability to work with news and fundamentals. Gold reacts strongly to Fed decisions, economic reports, inflation, rates. What are the risks involved? 1. You can quickly drain your deposit in case of a strong market movement against you if you trade with a large leverage. 2. You need constant monitoring. Gold can roll back sharply in just a few hours. 3. Psychological factors. Reaching $1,000 speculatively is not guaranteed every week. There will be weeks with losses. Let's consider the following method. B. Systematic option selling, covered calls, put writing. What is the essence of this approach? If you have a position in gold via a gold ETF such as GLD or futures, and you are willing to actively sell options, you can collect premiums every week or month. 1. Covered call. You have a long position in gold or GLD, and you sell a call option with a specific strike price and expiration date. If the price does not exceed the strike, you keep the premium. If it does, you have to sell the asset at the strike, but still at a profit. 2. Naked put or cash secured put. You sell a put option, take the premium, but must keep enough in your account to buy gold at the strike if the price falls. Let's find out why this can yield $1,000 per week. 1. If you have a large enough volume, e.g. 50 to 100 contracts of GLD options or gold futures, the total premiums can exceed $4,000 per month. 2. Option premiums increase when volatility increases. When the gold market storms, option sellers can earn higher premiums. Let's talk about what are the pros and cons of this method. Pros: a steady inflow of option money, especially during periods of sideways or slowly rising markets. Minuses: if the market sharply goes against your position, you may be left with a loss on the underlying asset, although the premium slightly mitigates the drawdown. What are the requirements and risks? You will need a medium to large deposit to trade a sufficient number of options. You need to understand the intricacies of options trading, know the sins, understand the risk of forced execution. Finally, consider Method C: active trading in gold miners' stocks, swing trading. If you don't want to work directly with gold and derivatives, you can focus on gold mining stocks. Their share prices often fluctuate more than gold itself. If gold rises by plus 2%, miners' shares can jump by 5–7%. This provides a speculative opportunity to get higher returns in the short term. Let's look at an example with a target return of $1,000 per week. Let's say you hold $10,000 in a stock, one or more companies, e.g. Barrick Gold Newmont. If the stock is up plus 10% for the week, a strong move but happens with favorable reports or a spike in the price of gold, you can lock in $1,000 of profit. That's 10% of $10,000. With a larger capital, let's say $20,000 to $30,000, you need a smaller movement to collect the same $1,000. You can also spread the amount over several issuers, trading a basket of companies to reduce the risk from one bad report. But you need to be aware of the fact that earning plus 10% every week is extremely difficult. Sometimes the market will go down and your stock could sag. During the relative lull in gold, the sector may freeze up and the volatility you need won't be there. There is a plan of action for reaching your goal of $1,000 a week. To have a chance of systematically reaching $1,000 a week, you must: first, determine your starting capital. If you plan to work on leveraged speculation, $10,000 to $20,000 may be enough for you, but the risk is very high. For a more relaxed style, such as covered calls, you usually need a larger deposit, perhaps $15,000 to $100,000. Secondly, you should choose a suitable strategy. Short-term trades, CFDs, futures, for more active market participants. Option trading, selling covered calls, for those who are ready to sit in gold but want to collect weekly premiums. Swing trading in shares of miners, an intermediate option. Thirdly, it is necessary to work out the trading system on paper. Backtest. For what? Conduct testing on historical data. See if it was possible to steadily pull $1,000 per week in similar market conditions. Make sure the strategy gives a reasonable profit-risk ratio. Fourth, try to establish risk management. Don't risk your entire deposit in one trade at once. Set stop losses, limit leverage. Always prepare for the worst-case scenario, as gold sometimes spikes on the background of news about the Fed funds rate. Fifth, constantly monitor the news on the financial markets. Key dates, Fed meetings, inflation data, non-farm payrolls. If you trade on US timeframes, keep an eye on geopolitical events. If you see that an important indicator is about to be released, you either limit your risk or enter a trade if you expect a specific price movement. Sixth, you should maintain psychological stability. This is the hardest part. Even the best system can give you several losing trades in a row. It is important not to abandon the strategy at the first failures if it is tested over a long distance. Try not to be greedy, closing profits in a timely manner, and not to sit out losses hoping for a reversal. Let's talk about reality and expectations. Every week will not be the same. The market can give you plus $2,000 one week, and the next week minus $500. On average, $4,000 to $5,000 a month with a competent approach and a large enough deposit is a realistic goal for an experienced trader. For a beginner, an attempt to squeeze $1,000 in a week often ends with over-leverage and rapid loss of capital. Start with smaller goals or with a demo account to build up your hand. Let's draw some brief conclusions from everything you've heard today. 1. $1,000 a week in gold is more of a speculative goal than an investment goal. Investors who just bought physical gold or ETFs are usually focused on years, not weeks. 2. The most realistic ways for similar results. Trading futures, CFDs using stop losses and reasonable leverage. Selling options, covered calls, if you have large enough positions at your disposal. 3. Deposit size is critical. $1,000 a week is $52,000 a year. Often, in order to consistently get such a return, you need to have at least $50,000 to $100,000 and also to trade well. 4. Risk management is your everything. Even professionals suffer losses if they underestimate volatility and changing market. And in conclusion, it should be said that, yes, gold provides opportunities for both protective investments and active earning. In order to purposefully receive $1,000 per week, you will have to trade aggressively enough or have a serious capital. And most importantly, constantly improve your skills in analytics, trading strategies, and risk management. Don't forget that long-term profitability in investments is a marathon, not a sprint. If you're constantly risking everything for a weekly profit, you too can lose it all quickly. So if you are ready for active trading and you have a solid plan, you may well get close to your goal of $1,000 in a week. But act cautiously, study the market, and remember that in the world of finance, there is no 100% guarantee. Stable earnings of this size are not always guaranteed. The gold market, like any other, is subject to fluctuations. However, there are approaches to earning about $1,000 per week is quite realistic with sufficient capital, knowledge of the market, and proper risk management. Good luck with your trades.